Most people are off, sometimes by thousands of dollars, when they estimate the tax on a 401k withdrawal. And that's because the IRS doesn't tax withdrawals the way most people think. I'm Justin, and after 20 plus years of helping people with retirement, this is what catches people off guard most. It's not just a single flat tax rate, it's more like a chain reaction. This can ripple through different tax rates, and it can cause more of your Social Security to be included in your tax. It can cause an additional 3.8% tax on some income, could cause your Medicare premiums to go higher, and more. In this video, I'll show you how to calculate your real number and, more importantly, how all of these ripple effects hit you. Here's a quick example. Say you're 66 years old. You've got $36,000 of pension income. There's $40,000 of Social Security, and you're married filing jointly. Right now, your total tax due is about $550. But if we add in $50,000 of a 401k withdrawal, what does that do? Simple math says you're in the 10 or 12% tax bracket, so that should be an extra 5 or 6,000 of tax, correct? Not quite. What ends up happening is an extra $18,000 almost of your Social Security gets included in your taxable income. Then the 50,000 moves across the 10 and the 12% tax brackets for a total tax due of more like 8,300. That's a couple thousand more than you expected. The good news is you can calculate all of this pretty easily using your own numbers with a free tool, the Dinkytown calculator. It's totally free. Just Google Dinkytown 1040, and this is what you should get. And by the way, everything we're looking at here applies to pre-tax 401k withdrawals, and it's very similar for pre-tax IRAs and even Roth conversions. So you got a break on your income when you put the money into these accounts, and now you're finally paying the taxes when you pull it back out. So for our example, you can just enter the information. You start by entering your tax filing status, and in this example, we used married filing jointly. Then you're going to enter all of your different kinds of income. We're going to ignore interest and dividends here, but you should certainly include that type of income if you have it. I'm entering a taxable pension amount of $36,000 per year, as well as $40,000 of Social Security benefits, and it immediately tells you that $16,200 of your Social Security is included in your taxable income so far. Make sure to let it know if you and or your spouse are at least age 65, because that will affect your deductions. And when we scroll on down to the bottom, you can see that the total tax due is about $550. Now I'm going to go back up and I'm going to add the $50,000 distribution. Going to put that into the taxable IRA distributions because that's also treated as ordinary income. And when we come back down to see how much is due, we see that the total tax due is $8,300. And by the way, as you're working with this, there's a little hamburger menu up at the top, so you can click to save a link or save your inputs so that you can come back to this later. And keep in mind a little wrinkle for 401k withdrawals. If you take a cash distribution, they typically have to withhold 20%. That's mandatory tax withholding, but it's not necessarily what you owe. It's just a deposit to the IRS. So you might get some of that back if you pay in too much, or you might owe more if you owe more. So let's add in a few more things to make this interesting. I'm going to add in a long-term capital gain of $100,000, and that's obviously going to increase the tax due. But what I really want to do is show you the net investment income tax. That's that extra 3.8% tax that happens if your income is quite high, and it only applies to certain types of income, like the capital gains, for example. So that might apply if you say, you know what, I'm going to pay off my mortgage right when I retire. I'm going to take it all out of my pre-tax retirement accounts, and that's going to be a $200,000 distribution on top of everything else. Well, we can scroll on down to the bottom, and we can see that the tax is kind of $57,000, but it's really more like $61,000. If we scroll all the way down, we can see that there's an extra $3,800 that gets added to the tax bill. That's 3.8% of the $100,000 capital gain. So Dinkytown is able to show you this type of thing. But there are some impacts that you just won't see on this calculator. For example, if your income rises above certain levels, then you may have to pay more each month for Medicare. That's those IRMA surcharges. That's not technically a tax, but it is based on your income and it hits your budget just the same. So for quick estimates, Dinkytown is surprisingly useful, but here's the thing. It only shows you 1 year. It's less helpful for long-term planning, and that's where more robust financial planning software comes in. The most popular one is, of course, Bolden for retirement planning, or you can use a financial advisor if you want. You can check out my pricing page and send me an email. Those types of tools look at all of the different moving parts together, and they can see those ripple effects like higher IRMA surcharges and net investment income tax, and then you can project things out over numerous years as well. So now that you know how to estimate your tax for a 401k withdrawal, you might want to look at which accounts you want to spend from first when you're in retirement. And the video popping up right now should help you with that question.